Hey, what's going on, guys? John Fibonacci here. Welcome to my video, The Successful Traders Trio. Now, this one is actually pretty special because the first time that I got to speak on a stage here in Houston, it was actually this presentation right here. Now, when I showed up, there wasn't a computer, so I couldn't use the PowerPoint. I had to go and use the notes off of my phone, and I gave them this presentation pretty much without any visuals. So yeah, but this is one of my favorite presentations only because it has, the kind of that sentimental value, right? Being a, speaking for the first time was this presentation. So but also because it is very important, right? The Successful Traders Trio, we're going to go over the three things that I believe every trader needs in order to succeed. Now, this idea is not mine 100%, okay? Larry Williams kind of touched on this. I don't think he called it a trio, but the inspiration is from Mr. Larry Williams, one of the, I personally think greatest traders of all time because of what he's done. But either way, much respect to Larry Williams. So yeah, credit due to Mr. Larry Williams, but that's who this was inspired by. So let's go ahead and jump right into it. All right, so it's called a trio for a reason. It basically is, if all three are not there, then it's not going to work. So you need all three. You can't have two. So you could almost think of it like a ring light, which I have up here. It's actually got 5 legs though. But if you have a camera stand, let's say like a tripod, for example, if you were to imagine a tripod standing up, if you took one of those legs away, that tripod would fall over, right? And so it's the same idea. You need all three, and 2 will not work. So the first one, and again, no order of importance because they're all equally important, but the first one, your strategy, otherwise known as your edge in the marketplace. Number 2 is going to be your psychology. So that is how you properly implement your edge. And I know there's a small little spelling mistake in there. I don't know if you guys caught that, but I always had to have a spelling mistake in the presentations just to, remind myself that I'm not perfect and to allow you guys to know that I'm not perfect either. And the third one, risk management. So that's your math system that works over time. So we won't dive too much into that, but small losses, big wins, things like that, trying to get your win rate up and stuff to that effect. So yeah, all in all, the three things of the Successful Traders Trio is your strategy, your psychology, and your risk management. All right. So again, touching on the idea that you need all three. I call it a trio for a reason. 1 or 2 out of 3 isn't good enough. So here's an example. You can have a great strategy and good risk management system, but without the psychological skills to implement the system and work the edge over time, the trader will not reach full potential. So psychological skills, that is something that Mark Douglas talks about. If you guys don't know who that is, legendary guy in the field of mindset and psychology, really more so tailored to traders. Okay. Yeah. So he's the author of Trading in the Zone as well as the Disciplined Trader. So if you don't have those, I highly suggest you pick those up. But yes, psychological skills are necessary. Here's another example. You can have a great strategy and great psychological skills to trade, but the moment you risk too much and lose a large portion or all of the account, that trader has failed. And our last example, you can have great risk management system and great psychological skills, but without a proper edge, growth over the long term is unlikely or may be really, really slow and, underperforming, say, the overall market like the S&P or something like that. So that is not really what you want either. All right, so let's talk a little bit about strategy. Obviously, everyone knows to buy low and sell high, or sell high and buy low, but what constitutes low and what constitutes high? What assets are you going to trade? Which time frames are you going to trade? What time of the day or day of the week are you going to trade? What is your entry technique and what is your stop loss placement? We could even talk about trade management, going break even, taking partials, order flow, things of that nature. It can get very complicated. We try to keep it simple, but these are things that I would think that every trader needs to know. So continuing on with the topic of what traders need to know, I have something for your notes. Number one, I believe that markets are manipulated. Number two, price is controlled algorithmically and manually. So again, we're going to expand on this more as we go through content, stuff like that. I can't throw everything obviously into one video, but these are some basic things that I think traders need to know. And a lot of this was in my best-selling book as well. So if you have that, you could also follow along a little bit as well. Number three, if it's obvious to you, it's obvious to everyone else. This may not make sense at first if you're brand new, but trust me, over time, you're going to hear me say that a lot. If it's obvious to you, it's obvious to everyone else. Number four, common knowledge is exploited. There is one saying that I use often as well. Observe the masses and do the opposite. So most people are wrong at turning points in the market. Most people are wrong in their analysis about most things as well. So, we like to look at what everyone else is doing and likely will do the opposite of that. So if everybody's bearish, I'm likely going to be bullish, or if everyone's bullish, I'm likely going to be bearish. And that usually works out pretty well. Number five, higher time frame bias trumps the lower time frame. So this means that the lower time frames are important, but they're not as important as the higher time frames. Number six, nobody wins 100% of their trades. You will take losing trades. That's just realistic. That's something that you need to know and implement in your strategy, in your trade plan, in your risk management, and things like that. So don't expect to be perfect. You will take losing trades. Number seven, confluence is key to high probability trading. Now, top-down analysis is as well. But when it comes to entries and things like that, especially if you know the mitigation model, if you've seen that reel, or if you've actually seen that presentation before of the mitigation model, then you already know confluence is key with that. And it's it's the key to high probability trading. Number eight, if you fail to plan, you plan to fail. Okay, I know there's another spelling mistake, sorry, but it's supposed to say if you fail to plan, you plan to fail. Guys, this presentation is a couple years old. I can't go back and fix it, so it is what it is. But yeah, I think that was Benjamin Franklin, if I remember correctly, who originally said that. If you fail to plan, you plan to fail. So you need a risk management plan, you need a trading plan, and psychological skills. Number nine, trading with emotions is a recipe for failure, or I would actually reword this to trading based on emotions is a recipe for failure. So it's okay to have emotions, but trading based off of those emotions is not a good thing. That is going to be a recipe for easy losses and potentially failure. Number 10, health matters. Okay, I'm usually not the one that talks the most about health and wellness, but over the years I've come to learn to be, more healthy and things like that, more health conscious, if you will. So, don't skip that. Don't skip like touching the grass and getting sunlight and drinking water and working out, eating better and stuff like that. So I'm not going to touch on too much on that today, but just know that stuff like that matters. Health is wealth. Number 11, sorry, the webcam kind of cuts it off, but the market is just information, and information is neutral. So the market going up is not good. It's not bad. It's just neutral. It's just information. All right. And same thing when the market goes down. It may not necessarily be good or bad. It's just information. You determine, you kind of put that analysis on it. You might think, oh, I'm long in the market going down is a bad thing, but in reality, it's just information. You see that price is going lower, and that's just the reality. So you put that spin on it, whether it's good or bad. So at the end of the day, though, it's neutral. Number 12, consistency is key to long-term success. So that's with anything, guys. I mean, you should know that. Going to the gym all the time, you see that it transforms people's bodies. Consistency at work or in your career may lead to, higher pay, potentially, right? And ranking up within that company, right? So you're more likely to be a manager, an owner, or whatever, and that's usually through consistency. All right, so we'll expand a little bit on that. The markets are manipulated, so it's not something to be fearful of. Knowledge is powerful. Use that to your advantage. So this is actually a good thing to know. Okay, it's a good thing to know because we get to use that to our advantage. And it's funny too, because as I mentioned earlier, I wasn't able to do this presentation in person because we didn't have a computer to use the PowerPoint, right? But today I get to show you the actual visual to that. So check this out. So here you have a chart of the micro E-mini S&P 500 index futures. This is actually the December 2021 contract. This screenshot was taken in October of 2021. You can actually see the date up in here. So again, I told you this presentation was a couple years old, but here we are. All right, so this is a classic example of manipulation here. Now, if you've never seen something like this before, this might be brand new to you, but if you're familiar with my content or if you've been around for a while, then you can obviously see what I'm going to point out to you. But if you want to look at this for a minute, you can pause the video and then, take a look and then come back. But I'm going to go ahead and show you what it is that I'm looking at, or that I want to portray to you. Okay, so down in here, you have sell stops and stop losses. Okay, when the market is consolidating, traders are placing sell stops below lows, right? Trying to catch the market go lower. And traders who are already long may have stop losses down there. So there's really multiple, order types there, but it's ultimately like they're different reasons, but still it's going to be essentially liquidity. So the orders may be for different reasons, but they're still going to be at the same lows and even below the lows. So with this run right in here, you see that candle has a wick that just dips below all of these lows in here, and then the market rallies after that. So that's kind of one of the signatures of a stop run, of manipulation. You could even go as far as saying like a run on stops, stop hunt, stop raid. There's an infinite number of names for this, but either way, it is manipulation at the end of the day. So after that manipulation occurs, you can see right here in this green box what price does. Well, what does it do? It comes down into that green box, and then after that, you can see that it explodes even higher over the next few candles. And that is what I'm referring to right there. The market takes off from around 45.76 all the way up to about 45.88, maybe 45.90. So I mean, that's a pretty substantial move on at least on a 5-minute time frame. Okay, so those are the types of trades that I would want to take, right? If we want to long the market, we want it to go up pretty quickly, right? And that's usually how we can spot some easy opportunities post manipulation. All right, so now we will talk a little bit about psychology. So as I mentioned earlier, the market is just information, and information is neutral. So it's not good or bad unless you think that it's good or that you think that it's bad. Number 2, losing trades is part of the process. No need to be upset. Now, I understand, okay? I know, trust me, after about 10 years of doing this, I understand that we might get upset at losing, but the more you realize that it's part of the process, and when you keep your losses small, you will learn to deal with them, more appropriately. Okay. You kind of, I wouldn't say get used to it, because I mean, you could get used to it, but it's still a little bit, painful, obviously, but being entirely upset to the point where it ruins your day, I think is a little unnecessary. So once you get comfortable with it, then you really shouldn't be all that upset. Number 3, revenge trading is the beginning of a losing streak. Walk away if you are angry. Now that last sentence, walk away if you're angry, that goes a little bit beyond just trading. All right. A little bit of anger management for you. All right. Seneca, I'm sure would appreciate that if you know who that is. But anyway, You don't want to revenge trade. All right. That's usually going to be the beginning of a losing streak, trying to get your loss back and stuff like that. Okay. So just be mindful. Don't revenge trade. Number 4, good or bad is subjective to each trader. Number 5, when in doubt, stay out. Okay. If you're not sure if the market's bullish, if you're not sure if it's bearish, you don't know what to do, or, you have a lot of doubts, then just stay out. All right. You won't take a winning trade, but you won't take a losing trade either. So again, it comes back to how you look at it, how you think about it. So when in doubt, stay out. Number 6, if the market stops you out, take the loss, learn from it, and move on. Do not dwell on losers, or do not dwell on losing trades. And I know it's hard in the beginning. It's more difficult in the beginning because you probably will take a lot of losses early on in your trading career. So, if you're not ready to trade live, then definitely don't do that. But what you want to do is learn from those mistakes. Okay. Don't dwell on the past. There's some trades that I took many years ago. I lost a lot of money quickly. Okay. And I can smile and laugh about it now, but at the time, man, that really hurt. I was dwelling on those couple losses, for a couple of days, and it really put me in not a bad place, but it put me in a very rough spot emotionally. So I wouldn't want, someone to go through that. So don't dwell on the losers that way. And this is another reason why we don't want to take big losses. We want to keep the losses small. All right. So don't dwell on them, but take the loss, learn from it, and then move on. Number 7, stop worrying what everyone else is doing. The Stoics would definitely appreciate, Marcus Aurelius would definitely appreciate this one. Stop worrying about everyone else. Okay. Someone else might be bullish or bearish or not trading or whatever, over leveraging or whatever the case may be. Everybody's journey is going to be different. Everybody's trading is going to be different. So when you are focused on anyone else, everyone else, you're not going to be as focused on yourself, and that's going to hinder your development as a person, as a trader, and that's not what you want to do. So try to keep the focus as much on yourself and your journey as possible. Number 8, practice patience. Guys, I cannot stress this one enough. I'm an impatient person. I'm an impatient trader, and that's usually does not go well all the time. So look, you got to work on that as much as you can. If that's a problem area for you, practice patience. Number 9, I say this one a lot too, to traders, and I tell myself this sometimes as well when I break even, is that a break even trade is better than a loss. So you're not really thinking about a break even in the negative light. You're thinking about a break even in more of like a positive light. And that's usually what I would want to do. So that's always going to, be better. A break even is always better than a losing trade. Number 10, look beyond the surface. Okay. Again, this one kind of goes beyond trading a little bit. It just means that, if you have issues, if you have problems in your life, it usually goes beyond the surface. So this is one thing that I did learn from, I believe it was Jared Tendler, and he authored a book, The Mental Game of Trading. And he actually talks about how if we might have a toothache and that we could brush our teeth and we might feel better, but then the next day we wake up and our teeth hurts again. So we try to brush it, but it's only a short-term solution, right? And the real problem is that we actually need a root canal. So we get that tooth removed and then we're pain free after that. So that's kind of what that means. And I think he has a really good example in that book, using that example, going to the dentist and whatnot. But yeah, you might have psychological problems that are deeper than what is just on the surface. So that's something that you're gonna have to figure out, and you're gonna have to dig deep into yourself and into your life and understanding. So look beyond the surface. Number 11, forgive yourself. Okay, you're gonna make mistakes. You're gonna, do things that are not advantageous for your trading or for your values, personal development, for your life, relationships, business, stuff like that. So you have to identify those mistakes, but don't beat yourself up. Forgive yourself and then move on. Number 12, forgive others. Okay, so forgiveness is basically number 11 and number 12. All right. Forgive yourself, forgive other people. I know it's difficult. It's very hard. Trust me. People have treated me very poorly all my life. Okay. Even to this day. All right. So that's just part of it though. We forgive them, we forgive ourselves, and we just move on. And that's really about the best that you can do, right? That's what we can control, is our forgiveness for ourselves and our forgiveness towards other people. So I think it's a good idea. Holding on to a grudge is not going to be beneficial to you or your trading. All right. And the last part, risk management. Number one, do not increase risk to get a loss back. Okay. You don't want to, martingale, I believe, is the strategy where you increase your risk to get your previous loss back. Okay. I do not recommend that at all. I don't recommend to increase the risk. Number two, there should be no such thing as a big loss. There should really only be like 4 outcomes to a trade: a small loss, break even, small win, or big win. Okay, so there should be no such thing as a big loss. Number three, losses are simply the cost of doing business. You have to pay to play. So again, we spoke earlier about how you are going to take losses. So if you know those losses are coming, then you might as well have them be small, right? And that's literally just business, right? In business, there are expenses, right? So if you're a restaurant, you're going to sell food, you have to buy that food, right? So that is a expense. That's just business. And at the end of the day, just like a business, they try to bring in more revenue, right? More profit than expenses. And in trading, it's going to be the same thing. Our wins hopefully should outweigh the losses. Number four, you do not need large risk to make large gains. So with leverage, if you've ever read the risk disclaimers, okay, leverage can work for you as well as against you. So if you are able to take a good trade that runs in your favor, then that ends up being a large gain, but you don't need large risk in order to make that large gain, despite whatever you have seen on the internet or Twitter or whatever. Number five, leverage is a double-edged sword. Just like I said a moment ago, leverage can work for you as well as against you. And this is why risk management is so important, and we need to be strict about it, because it can really rip your face off. Number six, decreasing risk after losing trades can prevent large equity drawdowns and or blown accounts. So this is essentially in alignment with number one, right? Instead of increasing risk, what I would typically do is decrease the risk. All right. So the equity curve, doesn't go exponentially lower. You don't want that. Okay. And you definitely don't want to blow your account. So don't increase risk. I look to decrease risk after losing trades or a series of losing trades. Number seven, trading rewards should be 3 times larger or more than risk on average. So in other words, the risk reward, when I look to take a trade, when I look for a setup, at a minimum, I need a 1-to-3 risk reward ratio. Okay. And that's just the math, dude. That's just math playing out over time. If we take, 1-to-1s, I don't really want to do that. 1-to-2s are better, but it's just 1-to-3 is my ideal minimum. And obviously it gets better than that, 1-to-5 and stuff like that. But I usually try not to go too large on the risk reward, but 1-to-3 is pretty nice. I need that in order to put on the risk. Otherwise, the risk is not worth the reward. Number 8, scaling out of trades is not a bad thing. The point of trading is to get paid. So in other words, give when the market takes. That was in one of the top 10 smart money trading rules, right? Scaling out of trades to basically get, something out of the market, because it may not always run to your TP. It may make a new high and then come back and get you out of break even, or, get a loss on that. But being able to take something out of the market is going to grow your account. And that's ultimately what we are here for. Number 9, never widen your stop once in the trade. Okay. So this is, again, one of the rules that I have for myself. Never widen your stop loss when in the trade, because, if you're going to outline risk, if you increase the stop, right? If you widen the stop, then you're increasing your risk. And that's not almost never advantageous for your trading performance, is widening the stop. So I think it's okay to move the stop in your favor to decrease risk, but to actively increase the risk, I think is a goober mistake, and I don't want to do that. Number 10, be careful moving your stop into break-even status too quickly. So if the market, full sprints, okay, if it goes my way very quickly, then sure, that's a good thing. But sometimes if the market is kind of moving casually and not doing too much, if you go break even too fast, that may be a trading mistake, because the market may come back, get you break even, and then go your direction, and that you missed the move now. So you bumped your stop too quickly, and that's not what you want to do. Number 11, be aware of the economic calendar and important news events. So I use forexfactory.com. I have the level 3 news filter on, which means all of the red folder news. And I don't want to trade usually going into the news, but usually post news events present some decent opportunities. So if you've ever looked at a chart and then randomly seen a huge candle, downside or upside, or maybe both, that's usually because of a news event. So you want to be aware of that. And number 12, avoid over trading. Know when to trade and when not to trade. So the economic calendar will help you with that. The holiday schedule will help you with that as well. And you can avoid over trading by having a set amount of trades per day, like a max number of trades per day. So it might be 2, it might be 3 or more. Totally up to you, but you don't want to over trade. All right, so I've been giving book recommendations for years, and these were the 3 that I came up with for that presentation back in late 2021. So here you go. Atomic Habits by James Clear, Trading in the Zone by Mark Douglas, and The Obstacle is the Way by Ryan Holiday. So I will put the links to those books in the description. If you want to help support the channel at no additional cost, you can do that. You can use the link to get them off of Amazon, and you can read them. And so that's pretty much going to be it for this video. So hopefully you guys were able to learn something. Hopefully you got value. If you haven't already done so, like the video. I would greatly appreciate that. Subscribe if you want to as well. You can hit the bell notification so you don't miss future content. We're going to be putting out a lot more videos. Trust me.